The broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everyone. Welcome to our members-only workshop for Investors Observer. We have these once every 3 weeks, and it has been 3 weeks since the last one. So we have our standard agenda this time, market update, what's going on in Investors Observer, and then the rest is member-driven content, questions, site demonstrations, etc. I got some questions ahead of time, so we have a few slides for those. As always, anybody who submits questions ahead of time, mention the workshop or just reply to that workshop email you get inviting you to the workshop. That's also a good way to let us know, and we can get things in. I can put some slides together and have some slightly more coherent thoughts for you than if you just ask in the workshop. Which is not to say not to ask during the workshop. Go ahead and put stuff in the question box at any point. If it's relevant, I'll try to stop and get to it immediately. Otherwise, we'll get to it during that section of the presentation at the end. All right, so here is our regular 2-year chart of the S&P. Those are daily candlesticks. Over here, we've got 3,000, and the all-time high is the only real areas of resistance left on the way up. We recovered from the turbulence we had earlier in the summer. I guess this was actually after the last Fed meeting is when this happened. So, we've basically recovered from that, and we're back at, I guess we're off a little bit from that level, but pretty close at this point. If we zoom in to look at 6 months, the things you can see here recently is the candles aren't nearly as big. Which is nice, right? It means less intraday volatility. There are still these long wicks here. And another thing worth noting is it's a lot less gappy in terms of, well, obviously there, but even from here to here, and here to here, and here to here to here, all those are big gaps, here to here even. What that means is there's a big difference between the closing price and the next day's open. And so when you have tightly spaced things like this, it means there's a lot less sort of overnight news going on and more trading is happening during the day in terms of what's actually setting the price. Which is nice because it turns out that things that happen overnight tend to be a lot of times less good for markets, and in some cases less good for the world generally. So it's kind of nice to have relatively small candles without a lot of gaps there. The one thing on this chart that does concern me a little bit is sort of this big gappy area here, and you can see it extends back to here, and it's kind of filled there. But that is, potentially a source of kind of an air pocket. If the market were to retreat again, it's a thing we'd worry about. I mean, there is obviously a support line here and one here, but it's a little, it's the kind of thing that makes people a little bit nervous. Hopefully it won't come into play though. All right, so we've been doing this stocks versus bonds comparison. Pretty much all of this up leg here is since the last time we had a workshop. I think some of this down leg is also. But yeah, it sort of seems like things have bottomed on the bond front. This move in terms of the severity of it, let's say, was kind of unprecedented. That also kind of tends to be what capitulation looks like, just in terms of something's nearing the end of its run and it's turning around. So we'll see. I'm not ready to call an end to the bond bull market yet, but certainly in the short term, I feel like things are going to be higher than lower. A return to 2%, I wouldn't be shocked to see. And you can see stocks haven't done quite as much of running in terms of here, which if we're concerned about this gap between the two things, which was the original point of this chart, that's probably not a bad development in terms of seeing bond yields rise on stocks go sideways a little bit. So that's the thing we'll be keeping an eye on. And the yield curve, you can see this little blip here where it inverted a couple weeks ago. It's back to uninverted now, and again, that only applies to the 10-year versus the 2-year. There are still some other sections of the yield curve that are inverted, which, yeah, I'm sure you've probably heard as much as I have about whether or not it's a recession indicator and whether or not this time is different. And I quite frankly don't actually know the answer, but it is a thing that has been a pretty reliable indicator in the past. So it'll be interesting to see what develops going forward. In any case, all right. What else is going on in the world? Trade is still a big deal. In terms of an actual agreement, no one, I don't think, knows anything. It seems like September talks are happening at a low level. There's been talks about some sort of October talks. No actual meeting between Trump and Xi has been announced. To me, that seems like a thing that's going to happen for there to be any actual deal made. I don't necessarily expect the two of them to sit down across the table and hammer out a deal, but I don't expect there to be an announcement of a final deal without Trump being there to take credit for it. So I think that's probably a signal that things are getting close to wrapping up, is if there is a meeting that between those two. And there's been a lot of talk last week or two about some sort of short-term deal. I haven't heard anything more about that recently. There has been a little bit of sort of easing of hostilities there, which is nice. Some things getting delayed, some things being put on tariff waiver lists, things of that nature. Certainly any sort of relief in that regard helps. So we'll see how that develops. The Fed, that was the big news today. I think they cut rates by 25 basis points, which is pretty much what everybody had expected. It's a little bit interesting. There were dissents on both sides of the cut in terms of, I think 2 people voted for keeping rates the same, and 1 person voted to cut rates by 50 basis points instead of the 25 they went with. I don't really know what to read into that, except that there isn't an obvious policy course right now. I think that's really the biggest takeaway there. And the Fed did say, I think I pulled this quote out from the statement, business, fixed investment, and exports have weakened. The first part of that sentence involved consumer and household spending being strong, which is the sort of trend we've seen for a while. That's actually the next bullet point. Some economic data has softened, but the consumer data is still, by and large, pretty strong. One interesting thing that I think a lot of ink was spilled about today was FedEx. Their earnings report was last night. They, I think, missed on earnings, reported inline revenues, and then cut their guidance, which isn't great. FedEx gets a lot of press because they report sort of between earnings cycles, and they're in the transportation business, so they have some, potentially FedEx's earnings could say something about the broader economy. But FedEx has had a couple of sort of rocky quarters recently, and I haven't really seen it show up in the rest of the economy. So it's not necessarily something to just ignore, but it's I'm not super worried about it at the moment either. Saudi Arabia is another, in terms of affecting transportation stocks a lot this week. The FedEx report sort of beat them up a little bit more than they had been earlier this week after the Saudi Arabia thing. The market reaction to that is interesting now, especially in terms of stocks. A few years ago, that's the kind of thing that would have absolutely been a big day in the stock market, a big down day. And the transports didn't do well Monday. All the airlines were down, things like that. But the shale production and generally onshore U.S. oil production is high enough now that, one, it doesn't have a huge effect on the actual price of gas here, and two, when the price of oil goes up, all those onshore oil producers, their stocks go up also. So if you look at the S&P 500 or something, sure, the airlines go down, but now there's all these oil companies who have stocks that go up where that wouldn't have happened a few years ago. So in terms of stock investors, unless you're holding a lot of airline stocks or something, that was sort of a non-event. Obviously, there's a long-term disruption in the supply, and it ends up to being, leads to higher prices for longer. That could start to actually hit consumer spending, which, as I've said 3 or 4 times now, is the strong part of this economy. So that's potentially worrying, but it doesn't seem like that's going to be an issue as of yet. And then Brexit, Parliament passed Parliament made no deal Brexit illegal. But there's no other options currently in place. So it seems like the most likely scenario is a kicking of the can to January 31st. I'm sure there'll be a lot of noise about not doing that between now and the end of October, but that seems like what's probably going to happen at this point. And yeah, who knows? Maybe they'll kick that can forever and they'll never actually Brexit. I don't know. That seems at this point that seems as likely as Brexit actually happening, given the seemingly intractable problems they're trying to solve in terms of reaching a deal. So that's the end of my market update. In terms of what's going on at Investors Observer, we have some stuff we've been working on that we're very excited about, but don't have a timetable we can announce yet. So stay tuned for that. Everyone will be informed by some number of means of communication when we're ready to announce that, and we'll make sure everybody knows. We'll probably have a special version of this webinar to announce it to everybody and things like that. So stay tuned for that, and we'll let you know when that happens. All right, on to the questions. So our first question was from Jeff. He had a question about one of our portfolio trades. He said on the original Lowe's diagonal spread, many people, I would say most people, did not get filled. I'm not sure anybody actually got filled at our posted price. I did hear from some people who took a different price. In any case, his question is, how long do we wait to get filled? If not filled, to cancel the order, a few days, a week, and he did get the second diagonal spread order filled. So in terms of leaving open orders sitting out in the market, how we handle that really sort of depends on generally 3 things, right? So there's the length of the trade, a trade that's only supposed to last 8 days, or something on a relatively short time frame. Probably not going to let sit out there unfilled for a week, right? Because if it was only supposed to be about a week-long trade, if somehow the market hits our price on the last day of that trade, it's probably because something's not happening that's good. Especially the kinds of trades we're doing here where we're primarily selling time value. Typically, that's not going to be good. So some of how long we'll let something sit out depends on the length of a trade. If it's a covered call that lasts 3 months, I might let that sit out there for a week and a half. But yeah, like a vertical spread that's only supposed to go for a week or two, probably going to be a lot quicker to adjust or cancel that. The other thing that we consider is the type of trade. Covered calls, typically we can let sit for longer than vertical spreads. Some of that's because they tend to be longer trades. Some of that's because there's still 2 pieces to the trade, but right, the call we're selling is the only thing that has any change in time value happening. There's not another leg to worry about there. And so the terms of being able to still get filled at that price, it just sort of changes slower in a covered call than it does in, say, a diagonal spread or a vertical spread. So we'll let covered calls stay out there the longest, and then probably diagonal spreads, and then vertical spreads we tend to try to adjust or cancel a lot quicker, just because of that. And then the other thing is, what is the stock doing? So I think Lowe's opened up 1% or 2% and we didn't get filled. That's very different from if it was up 5%, right? So if it's up 5%, well, now to me to get filled, the stock has to give 5% back. And I don't really want to jump into a position on a stock that just lost 5%. So that's the kind of thing where I would cancel it a lot quicker. Whereas, yeah, it reported earnings, we put a trade out, it was up 1 or 1.5% the next day. People like the stock and it's going up. Like, we guessed right about the stock, we were wrong about the price is how I look at that. And that's the thing where, in that sort of post-earnings euphoria, typically there's a little bit of extra volatility in both directions. So if it goes up 1% one day and comes back down 1% the next day and hits our price, that's not going to worry me too much. So again, that big move versus small move thing, right? Whereas, in all of these cases, right, length of trade, type of trade, what is the stock doing? Essentially what we're looking for is, what would it take for our price to get hit? And so in terms of a pretty short trade, right, we're losing time value every day. And so it's going to take typically the stock falling in order for our price to get hit after just a couple of days. And I don't really want to be in a bullish position on a falling stock or a bearish position on a rising stock. So I'm going to adjust that faster. The same, that sort of ties into the length of trade in terms of type of trade. And then, yeah, what is the stock doing, right? If it jumped up and just absolutely ran away from us, sometimes we adjust, like with Lowe's. I think we made the strike price $1 or $2 higher, and still we're able to find a trade we like. Sometimes we'll just cancel it and take it off the board because I don't like to chase things too much. But yeah, that sort of question of what would it take to get filled on this given the current condition? If what it's going to take is a big pullback, well, now you're buying a falling stock, and I tend to not like that so much. So that's the thinking that we do around here, and how we make that decision in any case. All right, next we had a couple questions from Lewis, who both his questions were about vertical spreads. But this first one was how to deal with a vertical option spread where one leg is in the money and the other is out of the money and is near expiring. So you kind of have several choices here. One, the one that we typically do in our portfolios, for reasons I'll get to in a second, is close it, right? Take what you can get and move on. The other option is hold it until if you think it might go back up. But obviously, as you get closer and closer to expiration, close it starts to look more prudent than try to wait it out. And the other thing you can do is you can leg out, right? So for a vertical credit spread, you didn't specify credit or debit here, but most of our spreads here are credits, so we'll stick with that. You can leg out, and you can actually close either leg depending on what you're looking for. So if you're expecting the stock to slide further, you can buy back that sold call, and if the stock keeps running against your original trade, your long option. Yeah, I mixed my option pieces here. I'll fix that for the piece we sent out. But yeah, buy back the sold option, right? So if it's a vertical put spread, you close that, and then if the stock keeps running down, your long put will rise in value, and you may be able to make up some of your loss that way. And then if your sold, if your sold option is in the money and your bought option is out, but you don't expect the stock to fall much further, especially if you don't mind owning the stock, you can buy the bought option, or you can sell the bought option, excuse me. At that point, your put, if it's a put spread, gets assigned. You own the stock at the strike price less your initial credit. And if you don't mind owning it, you can take it and write a covered call on it or something like that. So there's sort of the ways to handle that as far as that goes. We haven't actually done much of those second two strategies here, particularly selling the bought option, because we try to be mindful that we have a lot of subscribers who all have different different account and capital situations. And so if we go from a portfolio where, oh, well, these are vertical spreads and the widest spread we do is $5, and so you can do all these positions and never really put more than $500 into a position, and now we say, oh, hey, go buy 100 shares of something, that really changes the capital requirements for the portfolio pretty drastically. So we don't do that in the portfolio services for that reason. But certainly if you're trading on your own, depending on your situation, it's may or may not be a reasonable thing to consider. All right, and then the next question was, how often are options exercised early? If a spread has a sold leg in the money and the bought leg is out of the money, do I have to get out early if my account can't cover the sold option? So this is, again, another good question. Early exercise is pretty rare. The major exception to that is calls on ex-dividend dates. Those will be assigned if the remaining time value in the option is greater than the cash value of the dividend. That call is almost certainly going to be assigned. That's predictable, and you can, you can trade around it. It's 100% a thing that happens. Other early exercises do happen, but it's much less often and much less predictable. Like in terms of the calls, like there's a clear economic reason to do that, right? Like, oh, I have an option that's worth 20 cents and I can exercise it and get a 25-cent dividend. Do you want 20 cents or 25 cents? Like that's not a hard question to ask. The other early exercises, I've never really understood the economic decisions behind. And I don't think we have had some other positions where the options were exercised early in portfolios. I don't even think it's ever been a complete exercise. It's usually a handful of contracts here and there, which makes me think that it's one or two traders deciding to exercise something as opposed to everybody's just clearing this position out and exercising it early. So I've never been able to figure out exactly why or what the trade was that caused that early exercise. Because in the case of exercising an option, you're giving away the time value to exercise the option. So most of the time, I would rather sell an option and get the time value back than exercise it early. But that's how that goes. But yeah, that is rare enough outside of that dividend example. It's rare enough that getting out early just because your option is in the money isn't really necessary. And brokers will give you typically, one trading session to close trades, even if you have a non-marginable account such as an IRA. We've had those things happen here, and they can be pushy about it. When because of our auto trade relationship, I definitely hear from TD Ameritrade if I have some people with a non-margin account get assigned on something early in terms of a portfolio. They'll let me know before the market opens, and they want it closed by the end of trading that day, but they're not going to liquidate other positions or close accounts or whatever. Like the option gets assigned, then you have to sell the stock or whatever it is that happens there. It's not a big deal. And like I said, it's exceedingly rare. In hundreds of positions, I may have had 5 get assigned early or exercised early outside of that dividend example. It doesn't happen very often. Which is not to say it probably won't happen to you next week, because I have just spent 5 minutes telling you how rare it is, but it really doesn't happen very often. All right, that is the end of the questions and stuff we got ahead of time. Thanks to Lewis and Jeff for sending those in. Anybody else who has questions, feel free to put them in the box. We'll answer whatever you got. All right, well, I don't see a lot of questions coming in. Our next workshop will be in 3 weeks, which is October the 9th, it looks like. So I will talk to you then, if not before. You can certainly get in touch with us if you have questions or concerns prior to that. You can hit the help button on the website, or pick up the phone and give us a call. We're here from 8 until about 5 Eastern every day the market's open. You can certainly get in touch with us that way. And yeah, if you have questions that you want to see on slides or whatever in the workshop, send those in. But you don't have to wait for the workshop. We get some number of questions all the time, and we're happy to answer them whenever you need an answer. All right. Well, yeah, no more questions are coming in. So I'm going to go ahead and sign off here. But thank you all for coming, and I will talk to you again in 3 weeks, if not before.